With chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's going crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come, trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, August 2nd, 2024. And what an ugly week on Wall Street. So let's just go ahead and jump in the numbers. We've got quite a bit to talk about here. Of course, before I even do so, it comes as no surprise, right? I mean, if you listen to the podcast, you've been reading the newsletter that we just sent, this is not a shock. The market was toppy. It looked extended. It looked like it needed to roll over. I think we said a couple weeks ago, it looked like it was time. And that's kind of how it's been shaken out. So it doesn't come as a surprise, but it can still be alarming, right? Let's take a look at the numbers. Dow Jones down 2.09% on the week. The S&P 500 down 2.06%. The NASDAQ down 3.3%. And the small cap index down 6%. That's painful to see. Volatility index. If you may recall, I think I told you a couple weeks ago, I expected to see this thing jump up into the 20s. Well, it did. It was up 42.7% this week. Now, it finished today at 23.4, but it was actually up to just under 30 earlier in trading today, 29.6. You see a volatility index hit 30, it's like go time. It's time to buy. Didn't quite hit 30. Didn't do a whole lot of buying today. We did make some changes. We'll talk about that in a minute. But the volatility index has been on the move. I guess that's the point I'm trying to make there. Up 88% just for the quarter. It's really moving here. Just fear in the market. Fear in the market is what that shows. Expected volatility moving forward. So something to keep our eyes on. Take a look at some other things. Bonds, right? Now, unlike 2022, and if you're a client, had a review recently, we've been talking about this. Unlike 2022 when rates were rising, because understand something, bonds do poorly when rates are going higher. Let's say it's 2021 and you have a bond that's paying 1% for 15 years. Because believe it or not, that's all they were paying. And then by the end of 2022, brand new 15-year bonds are paying 5%. Well, nobody wants to buy your bond paying 1. If they go buy a brand new one paying 5. I mean, that's why we got rid of almost all of our bonds at the end of 2021. We were worried that 2022 was going to be a bad year for bonds, and it was. It was the worst year in United States history for bonds. Unfortunately, the stock market had a bad year also. So you had a year in 2022 where both stocks and bonds were down significantly. One of the worst years in United States history for the average American investor. Unlike 2022, rates are in a pretty good spot right now. You're seeing interest rates of 5 to 8% on your bonds. And if the market stumbles, if the economy stumbles, that means the Fed's going to be cutting rates and bonds should do well. That's exactly what we saw this week. Okay, so long-term bonds this week up 5.7%. So bonds doing their job, right? Going up while the market's going down, providing some protection, providing a hedge against market decline. So glad to see that happening. Taking a look at some other areas in the market, everything was just kind of sloppy except the real defensive thing. So staples, consumer staples are up 1% this week. And let me tell you something, the companies aren't doing that great of a job. And Procter & Gamble reported it was pretty terrible, but the stock ended up going up here at the end of the week because of the fear in the market. Healthcare was up this week, up 0.6. That's a defensive sector. Utilities, very defensive, up 4.2% this week. So all the defensive sectors were up. Everything else was down. Semiconductors down 9, discretionary down 3.5, energy down 4, financials down 3, industrials down just under 3. I mean, everything down. Technology down 5.5. So the only thing that was up on the week was communication services up 1.2%. And we can probably thank Facebook for helping out with that one. Gold was up this week, up 2%, and silver up 2% as well. So what in the world is going on, and what should you expect to happen next? Well, look, I think we talked about this a couple weeks ago when I said the market was toppy. The market will look for whatever reason it can find to sell stuff, to take profit. And listen, I think what we're seeing here is a lot of institutional repositioning. A lot of our industry is just kind of out of kilter right now. They're way overweight. The big 7 stocks that we keep talking about, Amazon, Microsoft, Apple, Nvidia, Google, Facebook, Tesla, they've been way overweight, these companies, and they're all coming back in, and they've got this kind of quickly reposition. So there's a lot of inside baseball happening right now in the market. Okay, the Japanese yen really was impacted this week as the Japan Central Bank came out with a very hawkish tone. Believe it or not, that causes all kinds of ripple effects with the yen carry trade. And I don't want to take you way deep into the weeds, but bottom line is it's hedge fund stuff, right? And it does have a major impact on things, not to mention the different offsides positioning on a lot of these major stocks that have been leading the market all year long. So there's a lot of unwinding going on there. We also had a lot of news hitting the headlines, right? We've had economic news has been weaker. We had a terrible manufacturing report this week, but manufacturing's been a doghouse for over a year now. I mean, that's nothing new, but it was worse than expected. The jobs number was much worse than expected today, 114,000. The street was looking for 180,000. That's a big deal. And I will say this too, the jobs number was so bad that the unemployment numbers kicked up enough to trigger a recession indicator. It's called the SAM rule, or SAM, S-A-H-M rule. It's created by someone at the Federal Reserve. And all what it is just if the unemployment level rises by 0.5% greater than the average over the last 12 months, something like that, within a 3-month period, it triggers a recessionary watch. In other words, it's like a precursor to potential recession. And I believe that can hold true. I've been saying that I think recession is in the cards for 2025. Now, the creator of this rule has actually come out and said, well, you may not be able to count on this indicator quite so accurately this time because of the immigration that we've had and things along those lines. But nonetheless, that triggered today. That was an issue. That's something to watch moving forward. In addition to that, the Fed had their meeting this week. Jay Powell and company did not cut rates. I was hoping they would. I mentioned it last week. I thought there was a possibility they could cut rates this week. I think they should have. I think the market, in hindsight, wished they had. I mean, because look, Thursday and Friday were just absolutely brutal. And I think if the Fed had cut rates this week, maybe the market reaction would have been a little bit different. But they've put it off, and they said that September is on the table. So we're going to see a rate cut in September. And you also see a lot of trading reacting to that potential rate cut coming in September. But I think if the Fed had cut rates, then the market would have better absorbed some of this weaker economic data that we had. In addition to all of that economic data, we've had some reports from companies that are reporting their quarters that have indicated a weaker consumer. Look, Wayfair, if you've ever done any shopping online from Wayfair, they said that their numbers are the worst they've seen since 2008. Now, keep in mind, Wayfair does a lot of furniture, things like that. So if housing is having some issues with interest rates being higher and lack of inventory, that's going to impact them more than others. Amazon came out, their quarter was pretty lousy. But then we see other consumer discretionary companies doing fine. I mean, DoorDash, people are ordering food and having it delivered. They had a good quarter. So it's still mixed out there. Facebook had a great quarter. They reported a good number. AMD reported a good number. There's been plenty of good numbers. But there's been some squirrely numbers out there, and the commentary, I think, spooked the market a bit because it really lent itself to a weaker consumer. Again, something that we have been talking about. Consumers been weakening. Credit card defaults are higher. Auto loan defaults are higher. There's issues there. But will the consumer bend or will they break? They may break at some point. I don't think they're breaking yet, based off the numbers that I'm seeing. Keep this in mind, too. We got a GDP number last week of 2.8%. That's anything but recessionary, okay? So we're not in a recession yet. We're not even close to it yet. But the cracks are all there, and the market's waking up to it. These are cracks we've been talking about. These are cracks that we've been seeing for some time now. And again, we think that it leads more into a risk of recession in 2025, not 2024. So a couple of things to keep in mind here. I think this is a shakeout right now in the market, but we could be in a seasonal downturn. I told you last week, we had a down week last week, and it's going to be interesting to see if we made a higher high or if we made a lower high and a lower low. Well, guess what? We made a lower high and a lower low. The market rebounded. It did not make a higher high. It fell short of that. And then we made a lower low than we did last week. So a downtrend is starting to form here. And it can break out of that pretty quickly. It could rebound next week, something along those lines. Or this could be here to stay for a while. And maybe the market's going to be ugly between now and the election. That wouldn't surprise me. The only thing that I find surprising about it is that it would start so soon, because August tends to be a positive year during presidential elections. As a matter of fact, it usually is a very, very, very strong month in presidential election years. So I'm surprised it's starting quite so early, but hey, it is what it is. It's not a surprise. We're expecting the market to take some hits here leading into the election. If we're going to take them early, that's fine. If not, if we do get a big rebound, I still think we're going to have a downturn in September and October. So I wouldn't get too excited if the market does rebound sufficiently or substantially in the next week or two. So we'll be watching closely. Look, right now, the market's hitting some strong levels on moving averages. The Dow Jones is right at its 50-day. The S&P is right at the 100-day. The NASDAQ's at the 100-day moving average. Russell's at the 50-day moving average. All these things are kind of right there on the cusp of some strong support levels. So it'll be interesting to see if they hold there. The indicators really don't show the market's really all that oversold yet. So it could get a little uglier before it turns. The DeMark indicators, I think there's a few more days we could see of weakness in the S&P before we get that 13 countdown for a buy, and we would see maybe things start to pick up from there. So there's a few things that I'm watching as far as the very short term are concerned. Again, this is not something I'm overly worried about right now. I'm more concerned about getting really defensive moving into 2025. I think it's early to do it just yet. I think this is a lot of monetary mechanics, a lot of hedge fund activity, a lot of institutional management. And I'll tell you something else. I've been watching volume really closely. Now today, Friday, the volume was high. But last week, this week, the volume has not been that high. And what I'm going to drill down here is this. There's two phases to a market. There's accumulation, there's distribution. Distribution, you can kind of see it. When you look at the charts, you see these really big spikes of volume with heavy, heavy selling. Big move down with high, high volume. We haven't seen that level of volume. As a matter of fact, we had greater volume in the downturn in April than we've had during this correction so far. So I want to see greater volume selling. That would tell me more about the broader market really getting fearful, really starting to brace for impact. And that would look more like what we would call distribution, which tends to lead into a recession. Not seeing that just yet. So again, I think this is more of a shakeout. I think it's more inside baseball stuff going on and nothing to be too alarmed about. But we did make some tweaks and some adjustments, taking advantage of the opportunity. So I did buy some more AMD this week before they reported their quarter. Normally I don't do that, but I expected a good quarter. And guess what? It was a good quarter. The stock shot up almost 10% that very next day. It's pulled back since then, but it's held in this 130s. My goal with AMD, we've had it for years now. We've bought, sold over the last 3 years. When it got down to the 130s, that was my trigger to buy more of it back again because we sold some earlier this year in the low 200s. So we did that. I sold Eli Lilly today. I know you're upset about that. All you people that have Eli Lilly in your portfolio, don't send me any mean things in email or anything like that. Look, it's done great, right? We bought it in March of 2023. And if you can go back and look at the price, you can look it up. But it's in the 300s, 330 range. And we trimmed some earlier this year. But man, the stock up to $900 some a share a couple weeks ago. It's rolled over. It's down in the 800s today. And the stock is just stupid expensive. I mean, it is so overvalued right now. I'm having a hard time wrapping my head around it. And I believe that you let your winners run, but the stock is just looking too overextended. And there's too much competition starting to come on board now with these GLP-1 drugs. I had to let it go. I had to cut it today, take the profit. We did that. Did an upgrade. Okay. We've had U.S. Bancorp, fifth largest bank in the country. It's been paying like a 6% dividend over the last couple of years. We've been collecting that dividend, but the stock's not done anything. I mean, it just really hasn't moved for us. We've got a nice dividend out of it, but we haven't gotten any appreciation. And I think Citigroup right now looks absolutely fantastic. They've got a new CEO that is really mixing things up there. The stock's been on fire this year, up like 15%, where U.S. Bancorp was like only up a couple percent. And I just think there's a tremendous amount more upside. Check this out. When you look at valuing banks, you look at something called book value, okay? And 1 times book is kind of like your point there of reference. Well, U.S. Bancorp is trading at 2.2 times book, and Citigroup is only trading at 0.7 times book. I think there's a lot of potential upside. So I made a change today. We sold U.S. Bancorp. We bought Citigroup. And I think that the upside there over the long term is pretty impressive. For all of you folks that have new money have come in, new clients that have come in, et cetera, all your money got put to work this week. Put it all to work into the model. Didn't hold anything back. Everybody's fully invested at this point in time. Now, I say fully invested. We still have 8% in cash. I sold Eli Lilly today. We still got some cash in the model. And we still got plenty of money in bonds in the model. So moving forward, if this market can give me a little more next week, a little more to the downside, we'll do some more buying. Otherwise, I kind of want to hold off to see what shakes out in September and October, because I do think we could see a little bit bigger move to the downside heading into the election. All that being said, recession does not look like it's in the cards just yet. I think it's maybe 2025. I don't think this market is imploding. If you look at historic interest rate cycles, the market has an average gain of 11% over the next 12 months from the first rate cut. Average gain of 11%. Now, there's been some real big drops, 08, 09, the 2000 tech crash. But look, we're not in anything frothy like that at the moment. We just aren't. I mean, when you look for these huge disconnects in the markets, like we saw in 08, 09, like we saw in the tech bubble, I'm not seeing that right now. I mean, look, we've had these AI stocks have been on fire, right? But I mean, NVIDIA, which has been maybe the hottest stock in the market, the forward PE is 39. Look, back during the tech bubble, forward PEs were 400 or 500. I mean, they were insane. So again, I don't see a lot of frothiness right now in any area of the market. The only thing I see frothiness is in national debt, and I don't think that chicken's coming home to roost just yet. So I don't think we need to be overly alarmed. And when you look at history from the first rate cut, 12 months out, average gain 11% in the market. First rate cut's going to be coming, folks. It's coming in September. So I don't think we need to get too worked up over this. I like where things sit. We'll look to make some additional changes and some purchases if the opportunities arise. Other than that, we hold tight and we let this play out. We were waiting for it, and here it is. All right. So I'm going to wrap up. Between now and next few meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it is retire a little early, take that big trip, start that new business, buy that new car, that boat, that RV. You know what your goals are. Leave that legacy, right? Maybe you want to be the rich aunt or uncle that leaves all the money to all the nieces and nephews you thought about forever. I don't know what your goals are. You do. Don't just think about them. Think big. Think big. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.